So, we're going to talk about monetary policy. Some things we're going to touch on today are the tools of monetary policy, conventional and unconventional, and then federal funds rate. So, what exactly is monetary policy? Monetary policy refers to the actions made by the central bank to manage the money supply. The Federal Reserve has a twin or dual mandate. This is ensuring price stability and maintaining full employment. So, we have conventional and unconventional tools of monetary policy. Let's start with the conventional tools of monetary policy. First things first, we have the reserve requirement. So the reserve requirement is the amount of money banks must hold in a reserve. So basically, this is a very powerful tool and is rarely used. For example, in March 2020, the Federal Reserve reduced reserve requirement ratios to 0% effective March 26, 2020 because of COVID. So the next one we have is a discount rate, also known as discount window. So basically the discount rate is a lending facility that allows banks to borrow reserves from the Federal Reserve. The discount rate is an interest rate charged by the Federal Reserve for loans through the discount window. So the discount rate is basically a bank borrowing from another bank because the discount rate is higher from the market interest than the market interest rate. So this is actually a bad sign for the bank when they borrow from the Federal Reserve because it shows that they are financially unhealthy. The next conventional tool we have is open market operations. So open market operations are sales or purchases of government bonds by the Federal Reserve to or from banks on the open market. So let's say if the Federal Reserve buys bonds, the amount of money increases, and vice versa. If the Federal Reserve sells the bonds, the amount of money decreases. This is the most used tool of monetary policy. Now, moving forward to the unconventional or modern tools of monetary policy, these have been instilled since 2008, ever since the economic crash. So the first one is paying interest on reserves. So basically, the higher the interest paid on reserves, the bigger our excess reserves in the bank. This also means the lower of the supply of money. So the next one we have is quantitative easing. So this is directly increased supply of money by buying government securities and other securities, such as buying long-term government bonds, or in 2008, they were buying toxic assets, mortgage-backed by securities. So, for example, in 2020, the Federal Open Market Committee, or FOMC, yes, announced that it will be purchasing Treasury securities and agency mortgage-backed securities in the amounts needed. This is just an example of quantitative easing. And so, last but not least, we have Federal Reserve loan facilities. So during the financial crisis, the Federal Reserve established several facilities to provide liquidity directly to borrowers and investors in key credit markets. These were established during COVID-19 pandemic new loan facilities. And finally, we have federal funds rate. So federal funds rate is the interest rate at which banks choose to lend reserves to one another. So banks are required to maintain a certain amount of reserves. We saw this in the borrowing from banks in the tools of monetary policy, the conventional tool discounted rate. So you can see that there. All right, well, thank you.